The next big trade is in bonds. Don't be the one that misses out. All that and more on tonight's Sunday Night Charts. We take a look at charts to help you with the trading week ahead. I'm your host, Steven Van Metre, and let's get right into this all-new edition of Sunday Night Charts. We have moving averages, colors on your screen. 21 days red, 50 days green, 100 days blue, 200 days tan. Price versus momentum. Price is a general direction. Price is red. Momentum is a rate of change, a bullish indicator for both is positive, and bearish indicator for both is negative. Momentum often, but not always, leads price. Technical analysis attempts to determine where buyers and sellers are at. Resistance is a level buyers can't break, and support is a level sellers can't break, or resistance is where sellers are at, and support is where buyers are at. Technical analysis does not predict prices. It can be used to determine the risk of a trade and help with time of trade and provide the direction of the path of least resistance. Charting offers possibilities, not probabilities, and not certainties. And we've got a bunch of updates because you said, hey, this is too complex. Make it easier. And boy, certainly to stay tuned in. When we get to the bond section, we've talked about how this breakout is coming, and you're seeing it in real time right now. Let's start out with the S&P 500. You'll notice now we're giving in the length indicators are now based on moving average. So you see 21-day, 50, 100-day price remains bullish on those. Means they're trending higher, but momentum on the moving averages unchanged still from last week is slowing down. So the rate of the increase in the moving average is slowing down. You notice now you see in green here above the moving day averages is really important because where do rallies start? When prices cross a moving average and reconfirm it. And then of course we have the longer term momentum indicators all flashing green. We'll do an example of what this is later on in today's show. Let's take a look at SPY. We've got the volume profile lined up, and you can see it's trying to break out. It is sitting at new all-time highs on Friday, and it wants to go higher. There still is volume trading up here. Sellers are trying to keep this thing from going, and buyers want it. And you can see the 6-month volume profile sitting right there at 416 on SPY, now acting as a level of support. It was down when price was down here, is acting as resistance. Bulls had no problem with that. Reconfirmed, you can see right here going back on the 3rd, reconfirmed against the volume support line, and now are trying to make even more new all-time highs into the weeks that come. It's all in the hands of the bulls. Can they keep the ball going? Let's take a look at NASDAQ 100, also unchanged. Those price across the moving averages bullish, but the rate of change in those moving averages is bearish. It is slowing down. But NASDAQ remains well above its moving day averages, and the momentum indicators are still flashing strong in the green. Let's take a look at QQQ, and you can see it is range bound. Now, what does range bound mean? It means it's trading sideways, and it's clawed its way back up near all-time highs, where it's previously found sellers. So right up here in between these two purple lines, this is a sell zone. This is where sellers have been. How do you know? Well, when it gets in here, you see selling, selling, selling. And, well, we'll find out if the sellers are done or if the bulls have finally overtaken them. And down here between these two lines, you have the buy zone. This is where buyers are. How do you know? Well, there's buyers, William down here, buying, buying, and buying. And the volume profile line is sitting right at 316, acting as a level of support. But up here, sellers have been defined. So this is not resolved. Now, then if the bulls can take this higher, you've got it. If they bring it down and break through, then you know there are definitely sellers still around. And this can continue to go sideways until either the sellers win or the buyers win. Who has more ammunition? That is the question of markets every day. How about small caps? Take a look at IWM. Price remains bullish against the moving average, still rising. Momentum against the 21-day is now turned up. 50-day remains bearish, still slowing down. And of course, most of the equity indices remain above their moving day averages, and the momentum indicators have all turned back green. Let's take a look at IWM, and it is too range bound, not making new all-time highs. Sellers are clearly up here. If we wanted to duplicate this line and we do this live, you can see this is technical analysis. What is it? It's identifying where buyers and sellers are at. Well, guess where the buyers are at? It's pretty clear. They're right here around this 211. Maybe we could even draw a line up here and say, hey, look, there's where the buyers are at. Sellers are up here, very much range bound. The advantage to the buyers is they've got this heavy volume of support sitting at 221 on IWM, acting as support at the moment. It's in the seller's court. Buyers have to break this through. So we see a lot of similarity between small caps and tech stocks. Remember, small caps tend to lead large caps. So if this rolls over and heads lower, puts the broad equity market at risk. Let's take a look at the energy sector, and unchanged here. Now, if you're new to this show, we denote changes in the price and momentum with an asterisk. So we see the moving averages are rising. Momentum is still unchanged, and now energy sector is below its 9-day moving average. This isn't a big deal. The 9-day will flip around. It's just when it starts and becomes a trend across the other moving averages, well, that's where you should start to be concerned. And what do we see here? And for some reason, the 21-day moving average didn't save. So we're going to go ahead and, since as many of you know, I don't edit, we're going to go ahead and really quickly add the 21-day moving average because we need that. And let's see if we got it. How close did I get? No, 17, 18, 19, 20, 21. Sorry for not editing, but that is just the rules of the show. Is we don't edit. There we go. There's a 21-day moving average. So you can see it's above its 21-day, above its 50, above its 100. This is still showing a rising trend. The 9-day not shown here, not a factor. What is supporting the energy sector? You've got XLE at 52.24 now acting as support. This was resistance. It got up into here, was resisting here, pushed through. How about we zip over to crude? And you can see crude driving new highs here over the last 6 months. It's got a bunch of support now sitting at the $65 range. Everyone's bullish on the U.S. economy, bullish on energy. Had a couple of weeks of builds in product. Not a danger yet if that continues. Of course, the question would be, without all these extra unemployment benefits, will demand stay for the crude oil and products? We'll see. How about financials? Unchanged price momentum. Prices still rising. Momentum is still strong here. We see financials now dipping below their 21-day moving average. This starts to show a red flag. This is your really early indicator. The 9, again, bounces around. It's just when the 9 starts dragging everything lower is when you start to get concerned. And it makes sense that financial stocks should be turning down. And why is that? Because bonds are about to rally. That's what you're tuning in to show to see. Been talking about this for a while now with this major Wyckoff bottom. We'll show you that. But here you see that price now below the 21-day moving average. See how it's kind of walked this up. The 50-day now in green is the next level of support for this. And you can kind of draw a zone here and see where the trading is at. So this is now turning into a sell zone. The question is, are there still buyers here in the financial stocks to push that even higher? And that is a question. But again, bonds are now saying, no, financial stocks, it's time for you to come back down. Only one of the two can be right. How about industrials? We see now price on 21-day moving average is turned down. Momentum is unchanged. It's below the 9 and 21-day. Let's take a look at industrials. We don't always look at industrials, but here you can see 21-day moving average curving down. You see it now looks like a potential small double top here. This rally coming to an end, and it's got a lot of support, but not until it gets down to from 103.51 all the way down to 90. That's where the heavy volume is at. So you're clearly seeing this volume up here. It's telling you this is where the sellers are at. All right, let's go. Oops, I didn't show you. Here's where the sellers are at. Didn't flip that over. Here's the volume support. Sorry about that. Like I said, we don't really do industrials too often. But remember, industrials, or if you're into Dow theory, well, the industrials will lead the broad equity market down too. How about utilities? Only change here is momentum on the 50-day is now back up. You see we're clear across above all the moving averages. One momentum, not a big deal, is negative and rising. This can go red and negative and falling. It's not a big deal at all. Let's take a look at utilities and see if there's any bull sign here. Where are you? I rearranged this to make it easier, and you can see why. You can see the 21-day curving up. You can see the trend is now trying to find higher. This is what technical analysts will say is a bull flag. That means utility stocks are going to go higher. It's holding right here at that previously zone that we identified where there's heavy volume. If we move out here, you can see that this is critical for the bull. If you're bullish on utilities, you want this to hold to run higher. And so far, it's looking like it's doing it. So that's a positive sign for the utility sector there. All right, let's go on to large gold miners. And a lot of people very bullish on this due to the inflation story, due to the fact they believe the Fed is printing money. And you see GDX, moving averages rising, momentum rising, now switching to 50-day moving average. Momentum is now positive, still remains below its 9 and 21-day moving average. 9-month momentum is negative and rising, not a major problem there. I would say the fact that it's below the 21-day moving average is maybe a early signal. Let's see what we can figure out on GDX. And it's not really a big deal. The big deal with GDX is this still a topping pattern where the bulls came in and still had one last hurrah? Or is this whole move here, this whole top, what looks like a top, been invalidated? That is the question. And so the fact that it's sitting under its moving average here is not a big deal. You can see the 50-day is rising. Momentum trend now is rising. And there's a bit of volume sitting here right at, quite a bit of volume sitting here at 38, and it's acting as a little bit of a headwind. The real question is for gold. If I was bullish on GDX, I would be very much okay with it coming down to this $36 price range, maybe even confirming, even if it dips below and holds this volume support line, which is at 35.60, or a retouch of its 50. Remember, rallies start with a cross of the moving average and reconfirmation, the 50-day being the most critical of it. The 21-day is just telling you where that trend is headed. So if you're bullish on miners, a rollover back down and confirming of support, say okay. I mean, in fact, you actually want that. How about emerging markets? Now price on the 100-day moving average has turned bearish. Momentum is unchanged on the 21 and 50, slightly below its 9-day moving average. Not a big deal. Let's look at emerging markets. Now, if you're bullish on GDX, by default, you have to be bullish on emerging markets. You don't get one without the other. The problem with emerging markets is you can see it's running into resistance again where it's ran into resistance before. Now, what was acting as a level of resistance, this volume profile line at 54, is now potentially a sign of support. So if you're bullish on GDX, you are by de facto bullish on emerging markets, and you want this to come down and hold this 50-day line that's rising, or the 21-day. You can see they're both headed higher. That's what you want. You want these sellers to get exhausted here, drive prices down, and where the buyers can take them higher. That's what you want, is to exhaust the sellers here. And if, like I said, if you're for one, you're for the other. And of course, you are also ironically bullish on Treasuries too. High yield bonds, taking a look at that 21, 50, and 100-day moving average price, all bullish. Momentum on them has slowed down, still is bearish on that. 1 month momentum negative and rising. Nothing exciting going on in high yield bonds. We look at this week after week, and there's just nothing of excitement to see, because it's pretty much where it's been the last 2 years, and there's a heavy amount of selling going on in the last 2 years at this zone. So what does that tell you? If you look at the indicators, right, if we go back here and say, well, this looks pretty good, would this be a position I'm really excited about entering if I was looking to put in a trade? No, because you look at where the volume support line is. If this turns out to be all people selling up here, yeah, there's no way I want to touch that. That is the question. Is the volume support line, which has been very clearly sellers, are the sellers now exhausted? It's not a risk that I personally would be willing to take, but so far there are eager buyers here that continue to want to take this up, and have for 2 years haven't made it. So that's not a good sign. It tells you kind of where the sellers are at. How about Treasuries? And now is where we'll get into I'll show you how these 1 and 3 month momentum work. Remember, this was all red at one point, and everyone was super bearish on this. And now look, 21-day, 50-day moving average back bullish across the board. We see the 21-day on price going bullish. 100-day is going to stay bearish for a while yet. It's above all of its key moving average, 9, 21, 50, and 100. The 6, 9, 12-month momentum are negative and rising. But what's the 1 and 3 month? You say, what is that? I don't get that. Well, let's take a look, and I will show you why these are so important. Because the 1 month is simple. You go to a 1 month chart, and what you can see, price is above where it is a month ago. That's bullish. So if you think about the bottom part here, and you're thinking about technical analysis, what does technical analysis do? It looks at a period. So you have a bottoming pattern, we'll draw with a mouse, and then you have this top. Well, if it's a bottoming pattern is 1 month long, then this tells you when it breaks it. If it's 3 months long, it tells you when it breaks it. It goes from yellow to green. So what are we seeing on the 3 month? on the 90-day, well, we're seeing it break out there. So we're getting, because here's price 3 months ago, here's where it is now. It's giving you all these indicators that if you're not an expert at technical analysis, that's what the momentum indicators tell it. Whoops, that was on HYG. I meant on TLT. Let's get on to the right one for at least while we're going to do this. And boy, I'm all over the place today. Here it is, 3 month. Boom, there you see the break, or 1 month, see the breakout. Let's look at the 3 month, 90 days. And it is breaking out because if you look at, this is 90 calendar days, we're looking at 9, and so we're seeing it go green here as momentum shifts positive. That is the key. So you're seeing it break out of this bottoming range right here, and that is technical analysis. Is you see this bottom part, this cup right here. Here's the top, here's the neckline, it's breaking out. That's what you want to look for. That's what those things at the bottom tell you. And you've got this massive amount of support. So if you're looking at this position and saying, look, it broke through this where everyone thought sellers were at, turned out those were buyers sitting at 139.50. And now that is a level of support. If there is a reversal, that is a very strong level of support. Moving average is curling up, going higher. And what we're seeing then across the other scales along the bottom is momentum is negative and rising over 6, 9, 12 months. So you're seeing everything you want to see that's telling you this is breaking out. Now, where does it go? If you're wondering where can this thing go? Well, usually bull markets take you back to prior highs and make a new high. So you're looking at a massive, you're seeing the same double bottom here to here, new all-time highs coming in bonds. You see it now. Will you jump on it? That is the question. That is your opportunity. Let's go on to gold. Now, gold, we've got above its 9 or below its 9 and 21 day. Everything, price, momentum unchanged. Let's go and take a look at gold. And you can see gold's got a lot of trading volume support at 1840. It's got a rising 50-day moving average. If you're bullish on gold, you want this to roll down, tag the 50-day, hold that volume support, and you got a winner. If it fails to hold, well, then now you know who's up here, sellers. That's how you read that. So if you're bullish on gold, you want 1840 to hold, and that will come pretty soon. How about silver? With, of course, the Wall Street team Reddit team trying to break this thing out. Price is bullish. Momentum flip bearish on the 21 day. Everything else looks green. Let's take a look at silver. And what do we see in silver? It's sitting right at the top of that range. Still can't break out. This is called range bound. It's sitting between an upper and a lower range. Both are defined. If you're bullish on silver, your bullish bet is that 27.23, all this volume is, there's buyers here now. If you're bearish, it's because this volume is sellers. That's the question. So far, this trend is bullish, but from a bigger picture, you can't call this. This is one of those positions where you just got to sit out and wait for it to happen, because this is range bound. Either you come out of range higher or lower, but it's too early unless you're going to try to chase these little cycles in here. So hold off on that one, because the dollar may be coming back. Remember, bonds are deferred dollars. If bonds are going to rally, dollar is going to follow. Price is bearish. Momentum now turning bullish on the 100-day. The 50-day flipping back bearish. It's above its 9 and 21-day moving average. That's a plus to get it going. Below the 50 and 100, 1, 3, 6, and 12-month momentum negative, and rising 9-month is negative and falling, but the 9 isn't that big of a deal. The fact that all these are now turning from red to yellow is an early indicator that the dollar here is headed higher. And you see bottom here, moving averages starting to curve and roll over. Here's the 50. You see the 50 days trending down. That's why that momentum is headed lower. The 100-day is flattening out. So at the moment, it's still too early to call on the dollar. But if you get to over this probably 92 range, you know you've got something interesting here. And if it breaks above 94, there you go. So the dollar's telling you the upside is coming. It's still too early to call, but the charts are looking really good. Anyways, we'll see you back on Monday for the macro show. The content of this video provides educational information only. It's not intended to provide investment or other advice. This show is not to be construed as a recommendation or solicitation to buy or sell any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Fighting or Steven Van Metre Financial.